Okay, so let's move on to the second leg of your trip to New York. What was your general sense there of the financial conference, and how are investors feeling post-elections and the Trump win?
Yeah, the contrast was quite remarkable, going from sort of 30 degrees in Mumbai to close to 0 degrees in New York, cold and dark. But actually the sentiment was actually really quite bullish from both investors and the management teams. And I met a wide range of companies across banks, insurers, and diversified financials. And I'll probably just summarize in four key thematics. One is regulation and the hope of deregulation post the election. I think that's really real, and there's a really strong sense of optimism around that, and I think that has important implications for capital M&A. The second thematic is really around capital market recovery. So again, that was probably somewhat in play before the election, but I think that there's a real sense now that people are leaning forward on that, and that looks like it'll start to happen more in 2025. The third is, I think there was quite a constructive update on the economy. So the consumer remains resilient and a source of strength. Corporates have probably also I think there's been a improvement in confidence, I guess, post-election. And then, the updates on credit, both on the consumer and the corporate side is still pretty good. And then the fourth thematic I'd call out probably would be the alternative market. So, again, exposed to those thematics that I talked about, whether it's capital markets and deregulation, but specifically, I think, obviously private credit, we all know what's going on there, but there's a lot of optimism about private wealth particularly, so putting alternative products down that private wealth channel, where private wealth is still very significantly underpenetrated in alternative products. So that's a big and quite a tangible opportunity for a lot of these businesses. But more broadly, I think there's and post-election, I think people are looking at putting alternatives into pension funds, so 401k plans. That's something that came up in a lot of conversations, and then also sort of putting it, structuring into sort of listed ETFs and everything. So yeah, really a lot of optimism around those four themes.
So just to round it out, how are you currently positioned for these specific themes? And I know there's a lot of additional work that needs to be done for all the new ideas, but how do you feel about your existing positions? And perhaps if you can share a bit about CBRE, which is recently entered into the portfolio.
Yeah, we've had a relatively full exposure to financial services across a number of different companies this year, and most of them have been beneficiaries, I guess, of what's happened after the election. So, and I did meet all of our holdings actually while I was in New York. I'd probably just call out two stocks. Both are quite significant holdings in the portfolio. One is American Express. So American Express gave a sort of intra-quarter update and really was around billings and through the holiday shopping festivals, in the United States, and sort of called out some really quite buoyant numbers around that, which I think would translate into earnings upgrades, and I think that's quite important. They also reiterated the sort of confidence in the growth algorithm. This is an exceptional business, high franchise, sort of fee-paying business. So, really a winning business in my view, and I came away relatively constructive from those meetings. And the other one is Bank of America. So, to some extent reflective of what the banks across the board are seeing. But I thought there was a particularly strong update from Brian Moynihan, the CEO, where he talked about NII continuing to inflect higher, loan growth improving, which is good for NII, but the yield curve is obviously starting to, certainly has flattened, and then maybe potentially start steepening again from here. That's a good environment for net interest income. Fee income from capital markets is good, credit's good, and there's a prospect of capital reform. So both of those were really quite constructive. And then to your question on CBRE, so I met the CFO and also watched the CEO present. Very confident, very positive. So just as a reminder, this is a scale, diversified, high quality real estate services, advisory, investment management business. And really, I think the summary investment case on why we've invested in that company is, one is this is a better, less cyclical business, high quality business than I think people appreciate, and certainly better than it has been historically. So they would classify approximately 60% of revenues now being, resilient businesses. So, by that they mean less cyclical and sort of growth advantage. So, driven by sort of secular thematics, and they would expect that part of the business to grow double digits for many years to come. So that was a real standout. And then the other part of the business is that more transactional, cyclical component, which we believe is in the right stage of the cycle now. So again, to my earlier comments, there's a real sense that side of the business, capital markets, and that part of the business, you can think of it as a JP Morgan of real estate. It's a sort of advisory, transaction-led business. So really came away quite constructive on both on all of those stocks. So good meetings.
Fantastic. Thank you, Jeff. For more information from Jeff and the team, please visit our insight section on alphinity.com.au. Thank you.
Thanks, Alfred.